Welcome back to the course Introduction to Commercial Banking, and in this course we have been discussing about banking sector regulation, especially in the case of global banking regulations, and we touched upon Basel 1, Basel 2. In this particular session that we are going to discuss, we will be focusing on Basel 3, but we will be also touching upon Basel 1 and Basel 2, and we will trying to see that how the Basel norms have evolved over a period of time and what have been the major reasons for the evolution and how so far India has adopted those and what has been the progress. We will be also touching upon some of the key concepts attached to the Basel III norms, and we will also try to have the numerical understanding that if we are going to impose those conditions on the banking sector, then how the different types of regulations and liquidity conditions will change, and what will be the course of I would say recovery for the bank if they are going to see a major shortfall. Now, in the post global financial I would say crisis era that started in 2008 after the Lehman Brothers collapse, what has happened that the banking sector has received major regulatory changes from the macroprudential side, and they have been subjected to different types of regulations. So Basel III came out after the global financial crisis, and it was mainly linked to the banking in general. So it became obvious that the banking norms would be revised, and Basel norms were further tightened to keep in mind the unexpected shock to the banking system. So thinking about in those lines that how it is going to work, so I have tried to touch upon these angles of Basel evolution 1, 2, 3, and what are the new changes that we are seeing with RBI trying to recalibrate the banking sector. So that we will have, and we will also have the Indian banking experience. So with this, let's move on. For this particular lecture, I would say that you can refer to some of these readings that I am showing you, and these some of the documents we have tried through the open sources from the Reserve Bank of India and the Basel Committee on Banking Supervision (BCBS). And these documents are important, but at the same time you can also touch upon the book of the Hull, Risk Management and Financial Institutions. They also discuss in detail about, and the rest of the books are up to you. You can also refer to Saunders and Miskin, but RBI document, and as I have mentioned previously also, that you can also touch upon the financial stability report of the RBI that comes 6 monthly, and it also gives a great deal of details about the Indian banking sector outlook, especially from the financial stability side. So with this background, let's move on. So what was the norms or need for the Basel regulation? So first was that they were so banks are highly leveraged institutions in the sense that fractional banking that we say, or fractional ledger banking that we say. So banks keep fractional ledger, but at the same time they go for I would say risky investment, and if those risky investments are or loaning are not going to be I would say fully materialized, then it will create problem, right? So this is what we often try to get into. So what was the risk? So mostly to align capital with risk. Second was the quality of capital, that what is going to be. So loss absorbing capacity, in the sense that if you have a bank A and bank A has 50 loans account, and out of this 40 are like non-responsive, which means that the bank is not receiving any kind of money from this. So only 10 banks they have. So how this 10 banks that is earning money for the bank, 10 accounts which are earning for the bank, are going to play an important role. So this is what we have. So quality of capital, liquidity and funding run risk, that in case of we saw in case of Diamond the Big model, that how for the later withdrawal depositors they were subjected to less amount because bank was selling the assets at discounted rate. So as a result, they were getting less money, they had less money to pay to the latecomers. So that we have, and the third most important part, which is linked with, which is like internal regulatory based supervisory norms, standardized conditions that we have already touched in the case of Basel norms. It is about the strengthening disclosures, that what disclosures we need for the bank, and at the same time, once we have disclosures, then we can analyze the data and we can get into a better supervision. So this is what, so capital and risk exposures are always important in this direction. Now coming back to the next part, which is about, so if you think about how we have evolved the banking regulation in India. So Basel I was introduced in 1988 at global level. In India it was introduced in 1992, and the first phase was so it took time because our banking system was evolving. So in 1991 we also experienced unprecedented external balance shock. So Indian government also took change, and at that time we have different Narsimham committee report. So between 1992 to 1999 phase, we had the implementation of the CAR, capital adequacy ratios, and other indicators that we have touched based on the weightage that we have, RWA. Basel II norm were introduced in March 2008. So risk sensitive risk weighted assets plus 3 pillars that we have seen. So those were the part. Basel III, it was introduced globally in 2010, but India took time, and then we had implemented lately, and then COVID also came, but it was started from 2013. So this is what we looked at, and in this particular session we'll be touching upon these important conditions, and we'll try to understand that whether these conditions are important. Now coming back to the next scenario, right. So what was the Basel norms? That the major regulatory norm for the Basel was the capital adequacy norm. It was 8%, but in majority of the countries where the banking sector played very important role in economic growth and development, so then the rate was much higher. So in India it was 9% up to 12%, right, and that's what we were able to find. So it was all sovereign and corporate loans. So corporate loan was given 100%, and most of the government oriented loans were given 0%. But since this was very, I would say, arbitrary kind of or very wide range of weight, so it didn't give the micro picture. So then we moved to the Basel norms 2, and then we were able to, so in Basel norms we also know that it had 3 pillars. So one was the minimum capital standards that every bank has to maintain, taking into account credit risk, market risk, and operational risk that they have. Then they had the supervisory review, and third was the market discipline. So in supervisory review there were a lot of internal database management and rules and regulations that also helped us understand the concentration risk, and also some of the analytical angles were also touched upon. Market discipline basically talk about the disclosure standards. So from pillar 3 onwards we saw that in Basel 3 the disclosure became one of the important criteria, but it was started from the Basel 2, and market discipline gets the more a chance. And unlike Basel 1, which was the based on mostly the capital adequacy ratio, which was for everyone, but then in Basel 2 it moved from one size fits all to more risk sensitive capital, because we started analyzing the individual specific the scenarios, and that gave us a lot of insights about. So this is how we look at and try to get into. And in Basel II, internal rating based approach created a good amount of, so standardized approach where like external agencies will be giving the rating, and this will give the clear picture of how your credit worthiness is. But in the later segment, internal rating based approach created a whole lot of analytics. So we discussed LGD, PD, and also EAD, and it also created a very good environment to understand the credit worthiness at individual levels. So it also created data. Then it was helpful to analyze data and go for governance, and then it was also helpful in validation requirements that created further, I would say, structural changes in understanding the overall implementation of Basel II. Then we had the certain constraints. So majority of the banking sector comes under the Reserve Bank of India in India, and we saw that certain legal norms and mostly the information technology related challenges, data quality, model governance capacity. So this evolved, but in 1991 we opened the economy for the global banking, and global banking system started operating from India. So this has positive spillover effect, and a lot of IT companies started helping the domestic banking system with regard to their automation characteristics, and also the internet banking and other services. That ruled out a lot of challenges that banks were facing, and this creates, for example, Finacle was developed, then further banking softwares were developed, and those softwares further created a good ground for the banks to streamline all the challenges, and it became quite a successful regulation, right? And this is how it created for us. So 1992 to 1997 we were able to get into these things. Now for this particular session, because most of the things we discussed so far we already discussed in last 2 to 3 sessions, but the purpose of this particular lecture is to give you the Basel III requirement understanding, that why Basel III is important. And we saw that after Lehman crash, global financial crisis gave a big challenge in the form of subprime crisis. And subprime crisis, why do we call it? Because subprime crisis, it was meant for the small borrowers. They were not able to pay on the housing loans mostly to the banks, and financial institutions were also having the backward and forward linkage that created the whole lot of shock spillovers, and as a result it became a systemic kind of event in US. So what were the major structural vulnerabilities? So one was the excessive leverage. Some global banks operated with leverage exceeding 30 times of their equity, which was like poor capital quality, right? Hybrid instruments like, for example, mortgage based securities, and also they were not having that kind of loss absorbing capacity, which means that capital tier 1, the common equity tier 1 was very weak for these banks. As a result, these banks were not able to absorb the shocks. Then there were a lot of challenges with the estimation of risk, and especially mortgage based securities became the MBS, we call it. So MBS became the major challenge in most of these institutions, and as a result they were not able to foresee or having a proper early warning system, and as a result this created a big tail risk for these banks. Heavy dependence on short-term wholesale funding, repo markets, and other were the and also the most important part was they had a weak liquidity buffers, which means that whatever amount that banks are having at one point of time, if we had created a scenario in which banks were also supposed to keep, apart from excess reserves or required reserves that we have, for example in India we have CRR plus SLR, if they're also told to keep 2 to 5% of their NDTL, net deposit time liabilities, then this would have become a big risk absorber at that time, but it was not there. And this created the asset liability mismatch also, because if you have a risk arriving from assets, on liability side it is already liability on you, so asset burden plus liability burden will create excess burden, and this may trigger the risk. And this overall it was that Basel I and Basel II were not meant to capture systemic and liquidity risk, and systemic risk will be discussing in detail. So basically the target of the Basel III norm has been the systemic risk plus liquidity risk, that why we need to target this. So and this is where I find that it is important that we should be looking into and trying to get the particular understanding about. So for this reason I thought this background is important, and this is what we often mention. Second thing was insufficient capital. So banks operated within thin equity buffers, underestimated leverage. So leverage has become a major debate issue in case of Basel III, because majority of the banks were having the understated risk weighted assets, and we discussed already how bank can manipulate the risk weighted asset if they are going to have the market based offer, or if they are linked to the some kind of market based outcome. So it will create a further the balance sheet risk. Liquidity vulnerability, that how high liquidity, high quality liquid assets with withstand funding shocks can play important role. Then here we have the maturity mismatch, that how the short term borrowing and lending with long term. So some kind of, you can say, operation twist kind of setup that we discussed already. And then the macro picture, pro-cyclicality. Pro-cyclicality in the case of US, Greenspan era created a big bubble in the housing sector, and this further, when it burst, it created a further shock to the macroeconomic system. And as a result, what was the case, that we saw the systemic episodes like failure or distress of major global banks, severe global recession, and large scale government recapitalization and tax funded bailout. So this created the whole lot of debate and understanding. Third, so in the Basel norms, when we saw all this background that banking sector was walking on a very thin rope, and it was anticipated that this will not be a true exercise for the bank. So what were the major innovations that we saw in the Basel III framework? And let's discuss one by one. So higher capital quality. So the emphasis has been on the common equity tier 1. This we have discussed already, that in case of loss observing, the CET1 becomes very important. So CET1 has to be standardized, and it has to be given higher preference. So we saw here. The second reason why Basel III is always in discussion, because of this capital conservation buffer, which means that 2.5% additional CET1 buffer. So apart from common equity tier 1, banks are supposed to keep 2.5% of their CET as buffer, which means that in case if they experience unanticipated shock, then this 2.5% they will be using. Then again they created something called counter cyclical capital buffer. So it is a macro prudential buffer during credit boom. So which means that banks have to keep extra money with this, and they'll have to keep. Then the leverage ratio, how much you have the exposure out of total the tier 1. So CET upon the total exposure becomes the leverage, and this is a controversial issue in the case of the banking system, especially if the banks are fully privatized, fully independent to regulate, then leverage ratio matters a lot. But if the bank is falling under regulatory body, then it becomes because exposure may not be completely in the hand of the bank. Sometimes banks are forced to have the exposure of the government policy. So in that case, it may play important role. So minimum tier 1 capital relative total exposure plays important role. Then second is liquidity coverage ratio, right? So they mentioned that survival under 30-day stress. So this is what it is. Then one more term that we have discussed already when we are discussing the NPH, GNPH, so NFSR came, so net stable funding ratio. So it also goes by the some kind of operation twist kind of setup. But you can see that as compared to Basel I and Basel II, Basel III has more focus on the banking sector financial stability. So that's why it is called that the Basel III norm is meant for financial stability. So what is the objective? Improve banking system resilience and reduce probability of systemic crisis. This is been the objective, and it also goes for macroprudential. We already saw in case of Basel II, but Basel III gives in terms of macroprudential regulation, and this becomes really important to note here. And a lot of time we often find that this is being discussed. Now let's shed some light on how it has been implemented in India. So in India, we introduced that in 2013 in a very staggered way. So Indian regulation, so it was like 9%, the Basel minimum 8% was required. Then we had the capital conservation buffer. So capital conservation buffer is 2.5, so 11.5. But you can see that in India, majority of the banks have more than 12% automatically, and I think for scheduled commercial banks and others, they might be varying, but we have found that majority of the Indian banking system, they do not have some kind of shock coming into. So you can see that we have recently gone by having around 16 to 17%. COVID shock created a favorable scenario to strengthen the banking sector, and also the improved capital buffer after NPA crisis 2015 to 18. So it also created a big challenge. So twin balance sheet and 4 balance sheet that we discussed. So all these in developments also strengthen the or it also gave the opportunity to the RBI to monitor and implement effectively these regulations and also bring or ensure financial stability in India. So these are the some of the important dimensions that we touched upon. If you look from the perspective of what we call it as the credit risk modeling, I think we have already covered this part, but I will be just giving you one example and then we'll move upon. So one is called probability of default, the chance borrower defaults over horizon, loss given default, so fraction of exposure not recovered after default, then exposure at default, so exposure outstanding at default, and expected loss. So if you just multiply all this, I think we have already touched upon. So I just wanted to give you that when we are discussing capital risk, that what all it has to be, and it has a lot of role play with the so for example, if I have to calculate MSME loan portfolio, micro, small, medium enterprises, so exposure at default is 200 crore. Probability default that we calculated is 3%. For example, our regression approach, whatever we can calculate. Loss given default is suppose 45%. So expected loss is going to be for the bank 2.7 crore. Lot of time expected loss is calculated through value at risk also, that at a particular level of confidence, what is the amount that you are surely going to lose. But expected loss is, so it is as I mentioned, that it is having the tail losses, right. So this is what we'll be discussing when we are going to discuss systemic risk measures. At that time, we'll be touching upon these angles. So expected loss that we calculate, expected loss, it is calculated in this way, and then we can superimpose the condition of a stress test scenario, that what is going to happen if we have more defaults, what is going to happen if the rate of interest is going to change, if it is restructuring, what all requirement that we have to face. In retail, you can think about, so a bank has retail loan, exposure at default is 500 crore, loss given default is 60%. So expected loss that we have, so here we have like a stress probability, so baseline probability default is 2%. A stress, if it is 5%, then how much we see in terms of incremental expected loss, so that we can calculate easily, right. So baseline, it is, we are just multiplying 0.2%, 2% is the PD, and 60% is the EAD, and then EAD is 500 crore, and then LGD is 60%, so it is coming out to be 6 crore. But we are seeing that as we are increasing the probability of default from 2% to 5%, we are seeing that the stress is increasing by 15 crore. And how much is the stress? Actually, incremental expected loss, it is 9 crore, which means that probability of default spikes. Further put a rapid capital procedure, I would say a rapid capital procedure for the bank, and it also sometimes it creates extraordinary pressure on the banking system, which means that if you are having higher risk of probability calculation, then this surely creates a negative impact on the overall capital structure, right. So this is what we look at. Now here we have the risk weighted asset that we have already touched upon. So risk weighted asset is when we are trying to calculate, so how we are getting into. So here we can go by simply considering different types of, so CRR, that here we have the capital adequacy ratio, then any kind of migration that we have, portfolio migration, which means that I am shifting the weight, so that creates, and again the concept of pro-cyclicality also comes in. So this is how we have. So for example, if I have to calculate the bank exposure, which is in rupees code, so corporate loan is 5,000 crore, so it has the 100% weightage, retail loan is 75%. So if it is, the amount is 3,000, so it will have the risk weighted weight of 75%. Government bonds have the 0% weight. The capital is 1,200 crore, so can we also calculate the RWA, and how we can see that the RWA is also going to change the CARAR. So RWA, we can see that it is 7250 that we are going to see risk weighted asset, and if you calculate the 7250, if we divide 1200 by 7250, we are going to see that the value for CRAR, it is coming to 16.5%, which means that if it is 16.5%, then bank is doing better and it is able to meet. So I hope with this background we are able to highlight or understand the basics of the capital adequacy and other Basel III norms. In this particular slide, I have tried to give you the exposure of how the risk weighted asset plays important role. So here we have, like, if we have to calculate this CRAR with the risk weighted asset, then how we can go about. So capital adequacy ratio, which is also called as the CAR, it is basically the total capital that I have, both tier 1 and tier 2 supplementary capital also, upon the risk weighted, and it creates the good scenario for the banks to get into, right. So if I am going to calculate this, so you can see that if the total regulatory capital, both tier 1 and tier 2, is 1500 and risk weighted asset is 10,000 crore, so we can see that the CAR is 15%. So which means that the bank has, what is the meaning of it? Which means that the bank has capital equivalent to 15% of its risk weighted asset, and this is where it is important. And it can absorb of the total, so absorb credit loss up to rupees 1500 crore without insolvency, because this is what we are getting, right. 1500 crore we have the amount, and capital adequacy ratio is 15%. So that implies that we are having the sufficient funds to mention. And he talks about the overall bank run scenario, that whether the bank run scenarios are possible. Now with this background, let me summarize what we covered. So in this particular session, we covered the introduction of the global banking regulation. We started with Basel I, CAR, then Basel II with internal rating based approach and the standardized approach. We saw that in Basel III, when we touched upon, we saw that the innovations that took place, it was mainly meant for the financial stability from the capital buffers, counter cyclical buffers. And at the same time, we also had the pro cyclicality and counter cyclicality dimension, and we saw that there is a more focus on the common equity tier 1 capital, because this is the most risk absorbing capital for the bank. So overall, what comes out, that from the 1988 era, when global banking regulation system was evolving, we are now in 2026. We see that the regulation has moved to a very micro level, and it creates a good scenario for the banks to also function, and it also builds a lot of confidence on the banking sector, easier for the regulator, for example the RBI, to manage this, and it creates a whole lot of good impact on the economy. So with this, I am stopping it. Thank you so much, and I hope you are enjoying the course. I really appreciate your attention.